All right, well, let's kickstart the Money Show without any further ado and introduce our very first guest, Harsh Roongta, to talk about the topic with respect to ETFs and passive investing. Harsh, thank you so much for joining us today on the Money Show and on ET Now. To start with, what's your view of, passive funds, index funds, ETFs? I know I'm mentioning all of them in the same breath, but we'll get into the nuances later. The underlying concept around all of these is that they follow a particular index and they are not very actively managed. So firstly, we are seeing ETFs, index funds gain a lot in popularity. What's your view on them?
I'm a great fan of index funds, and I think it is something which fits in with the basic philosophy that we have, that what is more important is asset allocation. When you are looking at any investment returns on any portfolio, the most important thing is how much asset to what asset class, how much to equity, how much to debt, how much to gold or whatever. Then the research shoes that even if you allocate whatever you have decided to equity to an index fund, and don't go into specific security selection, 90% of your return comes from asset allocation. And therefore, I think index funds fall very closely with that philosophy that asset allocation is far more important than security selection. And index fund aids in that approach, and therefore I'm a huge fan of index funds.
Interestingly, we have, so if we have to just talk about the entire concept of an index fund, they track a particular index. That index could be Nifty 50, Nifty small cap. It could be one of the thematic funds as well. Now we have so many ETFs coming up with thematic funds like an IT fund or a pharma fund, which have been some of the most popular themes. But the question is, considering that it is just tracking a particular index, Mr. Roongta, there are more than 40 mutual fund houses, and a lot of them have launched index funds or passive funds in these last couple of months. What would you look at to distinguish between all of these fund houses launches?
So actually in index funds, there is very little to choose from. The real importance is which index to follow. Okay. And that I think is a far more important decision than having decided, let's say you are going to go for large cap and therefore you're going to look at say Nifty 50 or Nifty Next 50. Then which mutual fund scheme should you choose? That again is this whole attitude about maximization, which I don't know whether it works too well. But if at all you really need to do that, then the one thing that you could possibly use is tracking error. Tracking error is basically the difference in the return between the scheme and the index that it is trying to track. There will always be minor differences, and lower are those differences. It does not matter whether those differences are positive or negative. When you're trying to track an index, you want to stay close to the index. You not even want to get too much ahead of the index, because that, how can you get too much ahead of the index if you're following the index? So I think you could use tracking error, I suspect, if you really want to choose between similar index funds of two mutual funds.
Okay, you mentioned that it's more important to choose what index to track versus what mutual fund house to pick. So at this juncture, Mr. Roongta, according to you, what's the index to track then?
That would really depend on the client's need, isn't it? As I said, asset allocation is important. So if I have decided on let's say equity, we are using index funds loosely, but I think people generally, at least in India, the indexes that are popular are still the equity indexes. So let's talk of an equity index. You have now a choice between, let's say, a wide index like a Nifty 500. You have a large cap index like a Nifty 50 or a Nifty 100 that's also a large cap index. You have a Nifty Next 50 You have a Nifty 150 mid cap. You can combine large and mid cap. So you can have a Nifty large and mid cap, which is the first 250. You could have Nifty small cap. I mean, it depends on your requirement and asset allocation. So if I have an allocation for small cap, I would use the small cap index. If I have an allocation for mid cap, I would use the mid cap index. I may combine them depending on the need of the client. So I don't think there is one answer to which index to follow. It depends on the client's need, his risk profile, what asset allocation he has provided.
Okay, Mr. Roongta, you mentioned that you could go for a scheme which has the lowest tracking error. Now, do you think that perhaps between large caps, mid caps, small caps, let's catch those indices for now, the most prominent ones. Have you seen that the large caps perhaps tend to have a less tracking error or more tracking error, or if that's the case in mid caps and small caps? And I'm going to add one more question then. Does that would you recommend then accordingly saying that, okay, go for an actively managed fund for mid and small caps and go for an index fund in large caps? Is this something that you have seen?
Oh, that's a lot of questions in a single question. But the first about tracking error, I think as you go down the liquidity profile, as the as the shares become less traded and mid caps are less traded, small caps are even less traded, the difference between buy and sell increases. And because of that, obviously the tracking errors will increase when you go for the lower cap indices and when you try and track the lower cap indices. So that is by definition, I haven't looked at data itself to say that mid cap or small cap has a larger tracking error than large cap. But large cap, for example, the lowest tracking error I have seen in an index fund is at about, in Nifty 50, is at about 15.15%, which is pretty decent.
Let's continue our discussion on passive funds, and we have with us a very special guest to talk about passive funds, about ETFs, about index funds, their benefits, how they play a role in your portfolio. I have with me Pratik Oswal, Head of Passive Funds with Motilal Oswal AMC. Pratik, pleasure having you with us on the Money Show today. You've been pioneering the entire passive fund schemes at Motilal Oswal. Over the last couple of years, there have been several new launches as well by the Motilal Oswal umbrella. Tell us, what's the mantra you follow? It's a very simple, hands-off approach that passive funds require. How do you at Motilal Oswal try to minimize what we call as the key parameter then to judge index funds, and that's tracking error?
Right. Thanks for having me on the show. Yes, we've been very busy launching a lot of funds. I think I think you launched close to 12 to 13 funds over the last 2 years, and our mantra has been fairly simple. When I did come in about 2 years ago, I thought that there were not a lot of options to invest in index funds and ETFs in India. So the idea was to give investors a lot of options. And the mantra was, it's very simple, building blocks for asset allocation. We personally believe that, asset allocation is a great strategy, for investors. And which is why a lot of our products that you see out there is based on that. So, we are currently market leaders in the international space. So, we have the highest market share out there. And even in the domestic segment, we are the only AMC with a comprehensive set of funds, across large cap, mid cap, small cap, multi cap sector, and also debt is something that we've also launched. So I think the idea is to make sure that an investor, if he or she wants to invest in any category of index funds, we have a product out there. Your second question was on tracking error.
What about the costs, Pratik? Because that's the key. Sure, go ahead, Pratik.
Yeah. So in terms of costs, yes, I think costs are extremely important because, most investors, who are looking at passive funds or index funds or ETFs, they need to make sure that, costs are minimized. So we have obviously ensured that all of our products, across all 15 funds are pretty competitive. And I think, we have one of the lowest cost providers, probably the lowest cost provider in I would say, most of our funds. The reason why cost is also important is because the lower the cost of the fund, the lower the tracking error of the fund. So tracking error is essentially it shows how efficient an index fund is in tracking the underlying index. So by having costs low, we're obviously ensuring that tracking error is low, but we're also sort of ensuring that the way we manage our fund is also quite efficient. So so that's just to talk about tracking error. Yes, it is different tracking error for different types of funds. So international funds have a different type of a tracking error. Domestic funds have a different type of tracking error. But essentially, we are looking at it from a pretty sort of low cost in terms of all of our funds.
Pratik, I'm going to now move it a little away from your mantra on managing your passive fund portfolio in Motilal Oswal to putting yourself into the shoes of the retail investor. Now, just for example, you at Motilal Oswal as well have a series of passive funds that track different indices from Nifty, Nifty Mid Cap, Nifty Private Bank, etc. The question is, how would you recommend investors go about choosing the index that they should track? Does it does the choice of index change, as the macros change, as the market environment shifts? So that's a great question. So I was talking about earlier about not having too many options 2 years ago, and now you have the opposite problem where you have too many options. So I think it's overall good for the investor community, but I think what's important is that investors stick to their risk appetite. So if an investor is not really okay with higher risk, then they should probably stay away from small caps or even mid caps. So essentially, it's very important for investors to invest as per their risk appetite, and they can look at a Nifty 50 or a Next 50 or a Nifty 100 for them to go out and ahead and invest their money into passive funds. We also suggest investors to take a sort of long-term horizon when it comes to index funds and ETFs. Why do I say that? Because if you look at the history of, say, these funds over the last not 5 years, but 20, 25 years, or especially even the US, where passive funds go on for almost half a century. What you'll see is that an index fund in 2005 was very different from an index fund today. 2005 it used to be materials, industrials, oil and gas. Today it's financial services and IT. So I think what you get of an index fund is a fund which will always track the top 50 or the top 100 stocks at all times. So it's really beneficial if you're taking a call for the next 30, 40, 50 years, especially if you're a young investor. So that's pretty much what we think is the right way. And if you look at index funds as well, most people tend to believe that index funds is only Nifty 50 or Sensex, but the US has 7,000 index funds in ETFs. India, you obviously don't have that many, but you have indices across different categories. You have indices across Nifty or Sensex, which is the most simplest one, and then you have mid caps, small caps. You have sector index funds and ETFs. You have international index funds, and you also have commodities like gold. So ideally, today I think investors are very lucky because they get to choose from funds, passive funds across different categories. And as I said, I think asset allocation is key for your long-term portfolio. So essentially, you can invest in sort of these funds across different categories. International funds is obviously an upcoming category, and I do sort of recommend investors to have a good, say, 15-20% of the portfolio there, because the US markets tend to move in different directions than Indian markets. Okay. Pratik, there's a belief among many retail investors. This is something that a lot of investors even ask us on our Twitter handles, on email, that, and I'll quote what they literally ask us, that I understand index funds are less volatile than active funds. I am approaching retirement. Should I move my money from active funds to index funds? Is that the case, Pratik? Let's take the example for a mid-cap index. Let's say you have an actively managed mid-cap index, and then you have a passively managed mid-cap index fund. Would you say that the passively managed one would be less volatile, or if you would like to debunk that myth as well?
Yeah. So that's definitely a myth. It's not true, So active index funds, and ETFs, passive funds are as volatile as actively managed funds. So there's in terms of I would say volatility, it really doesn't really make a big difference whether you invest in active or passive. Yes, you can have certain strategies within passive funds that control volatility. So you have something called strategy indices where you could invest in a low volatility passive fund, which obviously in that case, you are lowering the volatility of your overall. I think, at a very generic level, both are extremely similar in terms of volatility. What's really important about, at least from what I have seen, in the industry in India as well as the US, is that passive funds tend to be a lot more consistent when it comes to risk. So the risk profile of a Nifty mid-cap index today versus 10 years ago would be, to be honest, exactly the same, because you're running the same strategy. Whereas the risk of, say, an actively managed mid-cap fund may change over time. The fund manager might have a different strategy 10 years ago versus today. So I think, if you're looking at risk, I think people should also talk about the consistency of risk profile, which as I said, is a lot higher in passively managed funds.